The Rebel Capitalist Show.
You own several rental properties, and you're actually very hands-on with the management. So, how much are you increasing rents, or with your customers, with your investors?
Yeah.
How much have you seen annual rents go up over the last, let's say, 5 years per annum?
Well, I don't have an actual stat handy for you because it's fragmented. One
Right.
property will do this, the other will do that. And, you might have a tenant you really like and want to keep. And so you won't be as aggressive on rent increases. But what I will tell you is in an era where rates are very low, it is harder to raise rents a lot because the tenants have the option that housing's more affordable,
Right.
right? And they can buy. When rates are high, typically landlords can raise rents more aggressively because tenants don't have the opportunity to move as easily. So there's more demand for rental housing. But I would target, ideally you'd get 4% annually as a rent increase, but mostly the past decade or so, nobody's been able to pull that off very well. So, 3% annually is a good number. So, think about it. If you have a rental that's $1,000 a month, you raise the rent $30. No one's moving for $30 a month. Okay. It would cost more than that to just reconnect your utilities in a new
Right.
house and pay the movers, right?
Yes.
So,
What I think what people should do is take that $1,000 number and then, okay, so it's obvious what it is after a year, but then compound that at
right.
a 3% clip
Sure.
over, let's say, 5 years and 10 years. And then just remember that your mortgage is the same and then look at the difference there. Let's just assume that you're able to raise rents as much as inflation went up in the 1970s. To just think about that for a second and how much that would increase your monthly positive cash flow coming to the bottom line when your mortgage payment is fixed.
Yeah, that would be phenomenal. So you get the benefit of the fixed rate mortgage where the tenant has a variable rate,
Yeah,
right?
right,
And you
right.
get to make the margin on between those two. So it's a great deal for you. Yeah.
Yeah, and the reason I'm doing this again, guys, I'm not here to just say go out and buy a rental property right away. I'm just trying to get you to understand how owning a 30-year fixed rate mortgage is a benefit. It could be maybe even considered an asset, and why it's kind of like shorting the dollar.
It is. It's George puts it so well. It is. You're shorting the dollar here, and it's a great way to short the dollar because even if the dollar doesn't depreciate, okay, and you don't get a bunch of inflation-induced debt destruction, the likelihood is that the commodity value of these packaged commodities, and George, we did a video on that on your show a long time ago as
Yeah,
well, when I talked about the Hartman risk evaluator. Those
yeah,
commodities are going to go up in price, right?
yeah.
All these ingredients of the house, the lumber, the copper wire, the steel, the glass, the petroleum products, the concrete that all builds the house, the energy cost, et cetera. So that's good. And this is the reason this debt is good and other debt is bad is that this debt is self-liquidating debt. It
Mm.
you don't pay the debt. You outsource the debt repayment obligation to somebody else called a tenant. Okay. They pay the debt. Listen, if I'm going to take on a debt, I don't want to pay it back. I want someone else to pay it back for me. Right. And that's essentially what we're doing here. So it's self liquidating debt.
But let's
And if,
just assume that this is an owner occupant.
right.
And even if you don't have the renter paying your mortgage payment for you, the same concept that we're going over with these numbers is still applicable.
It's still applicable. It's just dramatically better on a rental property.
Yeah, right.
And if it, one more thing, and we'll go to the second spreadsheet here, okay? Um, if you liken this to the corporate world and the Wall Street world, here's a good comparison, I think. in the 80s, when all these corporate raiders became a big deal and we all heard about many of them for the first time, Carl Icahn, Ivan Boesky, T. Boone Pickens, all the rest of them, right? These are all big names. We had the movie Wall Street. One of the key things that they did that made them so successful is called the LBO, the leveraged buyout. And what a leveraged buyout is using it is trying to buy the company for as little or nothing down if you can, but as little down as possible, and then using the company's cash flow to repay the cost of acquisition. That's what we do with properties automatically. That's the way the system works. We buy it with a nominal amount down, and then we use the cash flow from the asset to repay the acquisition costs, self-liquidating debt.